There's a huge mistake that a lot of new people to trading and investing make, which is taking advice from already wealthy people. You've probably seen people like this, like they post quotes of Warren Buffett on their Instagram. They have like entrepreneur in their bio with like a little chart, like a little emoji of like a chart going up. Like you see these guys and it's cute, but it's a flawed mindset when you don't have a whale portfolio. The fundamental difference between you and someone already wealthy is that they have enough capital that they can afford to be risk adverse and still make tremendous amounts of money, whereas you do not have that luxury. You know, when you hear of like a Wall Street firm that makes 20% in a year and it's huge news, and it's like, whoa, they made 20%. You know, us in crypto, we kind of laugh at that, like, oh, it's 20%, that's nothing. That's it, 20%, and you're just like investing genius? Well, here's the thing, guys. If you have a $100 million portfolio and you make 20% in a year, you've made $20 million. Think about that. You've made $20 million. So what does the percentage matter? You've made $20 million. Like, I can keep saying that, but like, just to get that through people's heads, it really doesn't matter how slow someone's results are if they already have a huge amount of capital. On the other hand, if you have a 10K portfolio and you make 20% in a year, well, whoop-de-doo, like you've made 2K, which is cool, that's great, but you've made 2K. It's not going to change your life and, you know, significantly impact your standing in life, is it? And that's not to diminish anyone at all, but we're just speaking facts here. I started trading in crypto and I had like a few $1,000s in the crypto market, and I got to the point where I had a multi-million-dollar portfolio, which is on the higher end of the retail side, but it's still very much in the retail trading side. Guys that already have a lot of money really don't need to take on any risk. In fact, it benefits them way more to be very risk averse and get consistent results and predictable results from their trading. That's the focus. That's how the metagame plays when you're at that level. Even in like the crypto space that we're in, the crypto whales have their money in Bitcoin and Ethereum and maybe a tiny amount in some blue chip alts. Does that mean you should do that as well? Not necessarily. If you have like a 10K portfolio, you can afford to take some high risk investments. You really can. It might be better for you to go into the small cap altcoins, because let's say Bitcoin goes up by 20% in a year. Well, whoop-de-doo. Like, if you have a 10K portfolio, yeah, that's nice, like you've made 2K, but someone with a $10 million portfolio has made $2 million. So like, you're playing a different game to them. In my opinion, just my opinion, it makes more sense to delve into some higher risk altcoins. Another thing is liquidity. At one point, I had so many Shiba Inu coins that I could drop the price by over 40% by selling my bag. That's how big a whale I was of Shiba Inu in the early days. But that's only because the liquidity is super low. If you're like genuinely a really rich, like Warren Buffett kind of BlackRock, like super guy, even Bitcoin is too low liquidity for you. To give you a perspective of just how worlds apart us people are from like the genuinely wealthy firms and people, BlackRock has about $9 trillion of assets. You know, the cryptocurrency market, the total market, is like $1 trillion in market cap. So there's a liquidity issue there. If they put in $1 trillion into the cryptocurrency market, the price just shoots up and they get dumped on. So that's a liquidity issue. That's like a very rudimentary example, but you get what I'm saying. The less capital you have, you can actually go into these coins and these tiny altcoins and buy a large stake in them. Right? There's advantages and disadvantages to having a small portfolio, and there's advantages and disadvantages to having a large portfolio. But depending on what portfolio size you have, you're playing a different game. Like, you're not playing the same game here. The risk aversion goes up and up and up the more capital you have, which is why you probably shouldn't be listening to advice from these guys touted as amazing investors in the TradFi space, because their whole metagame is based on getting the most reliable possible results from their trading. That's how they make tremendous amounts of money. They only need to make a few percentage points of profit a year on average, and they're golden. You are not in that position. You actually have to take some risk and live life in the fast lane with us crypto degens. It's like listening to LeBron James talk about his cryotherapy routine to get better at basketball when you're a beginner basketball player. You guys are just worlds apart, and his advice doesn't necessarily apply to you. It would make more sense for you to go to the best player in your park and ask him for advice on how to improve your vertical jump, your shooting percentage, and how to dribble. That's what's going to make you a better basketball player. And in the context of this discussion, when you're talking about investors, you should look for someone that's a standard deviation above you in terms of how much money they're handling to get advice and ideas and so on from. But the guy that's already a billionaire or has like a 9-figure portfolio, anything he says is just going to be so different to your world. It's not playing the same game. The risk aversion, like the consideration of liquidity, is just very different from Joe Schmo that just has a few K in his Robinhood account. Like, it's just so different. Well guys, I hope you enjoyed this video. If you liked it, drop a like and sub for more.